Okay, it's 9 p.m. now. So thanks for coming. Hi, Chi Ho. Okay, nice to meet you all. So I think I won't wait for too long. So I start these sharing sessions now. So my name is Ming. I'm a full-time trader for past 7 days, and now I'm ventured into education field. I trade in forex, stocks, cryptocurrency, and also do automated strategies like using grid trading bots. So you all can check it out that what is grid trading and my others trading sharing sessions. So today I will be talking about option trading for beginners. So for last few weeks, I talked about what is options. So options mainly consist of buy, buyers and sellers. So today I will be talking about introductions to put selling strategies. So we will talk about sell puts in option trading. So today we will focus on what is cash secured puts. Before that, I will do a recap about what is options. So for the beginners or maybe newbie that just joined in this option trading, maybe you all can get an idea on what is options. So options, there has mainly two peoples, which is buyers and also sellers. And buyers always have the right. What is the right? For call buyers, the buyers always have the right to buy or not. And for the put buyers, always have the right to sell or not. And remember, for buyers in option trading, they always have a limited risk. They only lose their premium and max only. So got buyers, there will be sellers. So for sellers always have the obligations. So what is obligations? Obligation is if the call buyers have the right to buy, then sellers have the obligations to sell. Sellers need to sell. It cannot choose to sell or not. But for call buyers, they can choose to buy or not. So call buyers will make contracts with the sellers, and call sellers are obliged to sell while call buyers have the right to buy or not. Today, we will focus on these put sellers. Put sellers are obliged to buy, whereas put buyers have the right to sell or not. And for sellers in option trading, they always face unlimited risk. So for those who don't understand why sellers will face unlimited risk, maybe you all can look back to my previous sessions or maybe wait for another option trading introduction sessions in the upcoming next few weeks. So you all just remember, for buyers in option trading, they always have limited risk. It's like if you trade buyers sides like call buyers or put buyers, first you always lose the premium. The maximum capitals you will lose will be the premium. Whereas for sellers, the risk is unlimited. It means maximum profit you earn from the buyers will be the premium. Whereas the maximum risk for the buyers will be the premium. The sellers will earn the premium from the buyers, and the sellers will face unlimited risk. So how will we benefit in doing sell sides? So today we will focus on sell puts, which is we became the put sellers and we are obliged to buy. So here you can see for put buyers, you have the right to sell. But when we become the put sellers, we are obliged to buy. It means that we need to buy the stocks from the put buyers. So here, to buy, it means to buy the stocks. So you can maybe you can get the idea that become the put sellers, we want to buy the stocks from the put buyers. So we can say that it is something like a buy limit. So you all just remember these words, buy limits, then you all will get the idea along with the sharing later. All right, so this is an idea of what is option trading. And today we will focus on the put sellers side. So what is cash secure puts? It's an option strategy that whereas the investors sells a put options and set aside the cash needed to purchase the underlying stock if assigned. So you all remembers that if you become the put sellers, you will face unlimited risk, right? So the difference between the purely put sellers and cash secure puts is when you do a sell put, you need to prepare a set of money to buy the stocks from the puts buyer, right? So this is why it calls cash secure puts. You need to have loads of cash to buy the stocks from the markets. If you just do a naked put sales, you will face a lot of you will face unlimited risk because you didn't prepare the money. You don't have the money to buy the stocks, so you will face a massive loss. This is why we need to only trade cash secure puts. We only need to sell puts when we have enough cash to buy the stocks from the put buyers. So it doesn't mean that you can't do a naked sell puts, but it's very dangerous because your maximum earning will be the premium, and you will face maximum loss. No, maximum unlimited loss risk, unlimited loss. However, if you have the enough cash, you just buy back the stocks and your loss is limited. And in the next few slides, I will explain how can we benefit by doing this cash secure puts. All right. And then when we do cash secure puts, selling cash secure puts, we can generate consistent income while potentially buying a stock at a discounted price. All right. So the ideas to do sell puts with enough cash aside is to generate income while buying a stock at a discounted price. So I will show you all how can we generate a passive income while we can get the stocks at a discounted price. So this is an idea of put options. You can see in put options, there will be the buyer, put buyer, and there will be the seller, which is put seller. And buyers pay the premium to the seller, and the seller receives the premium. So in this case, we became the put seller. So we aim to receive the premium, right? And then we are obliged to buy the stocks from the put buyer at strike price. And for the put buyer, they have the right to sell the stocks to the put sellers at strike price. While put buyers want the stock price to go down, because when we buy a put buyer, we long puts, we want the price to go down and we earn. However, we as a put sellers, which is against these put buyers, we want the stock price to stay stagnant or goes up, so that we can receive the premium, right? We don't have to buy the stocks from the put buyer, from the put buyers. All right. So this is an idea and the relationship between the put buyer and put seller. We now become the put seller who aim to get the premium as a consistent income, just like an insurance agent. They insure you and you pay the insurance fee, the insurance buyer which pay the insurance fee, and you just for the insurance seller, we keep get the premium, and become to get this consistent main income, consistent income. So just remember, put seller don't want the price to wants the price to went up and sideways, so that we can earn the premium. Sellers always target the premium, and buyers maximum lose is the premium, because this limited their limited risk is they have limited risk, which is only premium. They pay the premium, and maximum of us as a put sellers will be the the maximum premium we receive. So here, as I just mentioned, put sellers aim to buy the stocks from the put buyer at the strike price. So how it works, how these put sellers works. So first, we choose a stock and a strike price below the current market price. Then we sell the put options and collect the premium. When we sell the options, we will get the premium directly. We will instantly get the premium because we sell and the put buyer will pay the premium. Make sense? We now is sell put sellers role. And step 3, we need to prepare enough cash to buy the stocks at the strike price if assigned. Okay, so choose a stock and a strike price below the current market price. So if the stocks, okay, we just continue this about concept first, then I will give the examples. So the possible outcomes will be the put options expired worthless, which is good. Why? Because put buyer will lose the premium. When the put options expired worthless, the put buyer will lose the money. And who earns? That will be us as a put seller, because put buyers will always deal with the put sellers. Our role will be the put sellers, and we receive the premiums from the put buyers. So when the put options expired worthless, we as a put sellers will take the premium as the profit. So we keep the premium. So what if the option is assigned? The option is assigned means the put buyer expired in the money. In the money means the put buyers earns, the market price drops, and we need to buy the stocks. The put buyers exercise his right to sell, and we as a put sellers has obligations to buy the stocks from them. Make sense? For the option expires, the put buyers lose the premium. However, for the option when the put buyers assign, for the put buyers, when they earn money, so they will exercise the price to sell. So we need to buy from them, because we as a put sellers have obligations to buy from them. So buy the stocks at the strike price effectively lower cost basis. So I will explain why we can buy the stocks effectively at a lower cost basis, which means we can buy the stocks with a discounted price. So further on, I will give the examples on this put option selling. So for examples, current stock price will be $50. and the strike price will be 45. Then the premium will be $2 per share, and the contract shares will be 100 shares. So with the examples, there will be a few scenarios. So scenario 1, the stock price at expirations is 48. So now the stock price is above the strike price 45. The put buyer's options will expire worthless. So I give you maybe a few seconds to think about when the put options expire worthless, when the put buyers lose money, who earn the money? Right? Us. We put sellers will earn the premiums when the put buyer lose the money. Put buyers always want the price to went down. But in this case, it didn't went down below the strike price. Instead, it stayed at $48. Our strike price is 45. So here, our net profits will be what? Will be $2 times 100 shares, one contract, which is the premium. Our maximum, as a put sellers, always remember that our maximum profits will be the premium. We just want to aim the premium. We just want to aim earn maximum premium only. So another examples, current price, stock price is $50 and the strike price is $45, premium $2 per share, and the contract size will be 100 shares. So what will happen? So what will happen when the stock price is at expiration of $40? So now the options expired and it stays below 40 and the strike price is 45. So this is in the money for the put buyer. When the put buyer earns money, then the put sellers need to buy the stocks from the put buyer. So the option is exercise. And why just now we said we can buy at the discounted price? It is because let's say the strike is 45, right? We buy the stocks at $45 from the put buyers. However, remember we have already received the $2 premium. So it means that a $45 stocks, we bought it at $43 per share. So this is how we can buy the stocks at the discounted price, because we earn extra premium when we sell the put options. All right. So in this case, we need to have enough money to buy the share, right? You just think like that. In this put option strategy, you already want to buy the stocks. Let's say in this case, the strike price, you already plan to buy the stocks at $45. However, current price is 50. You either need to wait it to drop or it stay above. If it stay above the $45 strike price, you will get the premium. But upon expirations, if it hit below the strike price, you just buy the stocks at $45. While you're making a $2 premium, so you buy at a discounted price. So this is the win-win situation if you already plan to buy the stocks at that current price. So this is the beauty of selling puts. Cash secured selling puts. You need to prepare a certain part of cash aside. So make sense? So until here, if you all have any questions, you all can type it in the chat box. I will really reply to you all, and don't be shy, and any questions, just ask me. And I hope you all can understand this, because for some people, options can be very hard to understand. but actually it is not that hard, and I will try to keep repeats until you all had the idea of it. All right. All right. So no worries. This is an idea of it. So in put option selling, what is the benefit? Benefit is generate income from premiums. So we can earn the consistent income. Let's say you have already have a cash, you prepare a cash to buy, you wanted to buy the stock, let's say just now at like $45. Now the stocks is at $50. While waiting the stock to drop to $45, you sell put at the strike price. If it upon expiry, if it didn't hit the $45, which is you need to buy, which is the buy limit, you need to buy the stocks, you can earn the premium. However, if it hits the $45, you just buy it. Right? You hit below $40 or what, you just buy it. You remember you buy the stock, you intended to buy the stock at $45. If it hit below 45, you just buy it because you aim to buy at $45. And then you buy at discounted price because there is the premium there. All right. So yeah, the benefits, like I said, you have the opportunity to buy a quality stocks at a discount. If you directly buy at the market, you just put a buy limit. You don't get extra discount, right? Because you don't have the premium generated from there. So by using options put selling, you can generate this income. I mean, it can be a passive income, and then you can get discounted stocks, and you can get a good price while waiting the price falls down. You can get a good income while waiting the price fall down. So this is the beauty of sell puts, cash secured sell puts. Remember, you always need to have enough money to buy from the put buyers. All right. And it will lower the cost basis compared to direct stock purchase. This is why I say you can buy the stocks at a discounted price. Next, we will talk about the risks. All right. So what is the risk? The risk of sell puts, if you don't have enough cash, you will face unlimited loss, right? Because you don't have enough cash, then you suddenly need to buy a stocks at like maybe 220,000, something like that. If you don't prepare enough cash, you need to face a lot of risk. And the risk, some people say is the risk like you have limited profit potentials. However, in selling puts, we just want to buy the stock at a lower price while waiting it falls down to the lower price. So we just sell puts. So it says that the limited profit, yeah, when you do a selling in option trading, the maximum will be only the premium. But since our main goal is to get the stocks at a lower price and discounted price, and while waiting, we can generate a passive income. So it's not considered like really a bad thing, even though it's stated that the premium is kept. And yeah, this one is the bad. No, I mean the downside of the put option selling. It requires significant capitals to secure the trades. And for you all to know that in this trading world, Warren Buffett had used these sell put strategies to get the stocks he want at a lower price. One of the reasons with big capitals, you can easily make a good income in these sell puts. Imagine it's sell put strategies, maybe you can earn 1 to 2%, and you sell it every month. You can estimate it, I mean, easily 20 to 30% per year. For those who have big capitals, they like to sell these puts because it's safer and the the winning rate is very high. And you can generate the comfortable income. And yeah, and while waiting, the stock price comes down to the price that you wanted to buy. So this is a win-win strategies in option trading. So for best practices, we use the cash secure puts to own the stocks that we want to own. Because we want to buy the stocks at the discounted price and intended to own for a long term. Why? Is because let's say just now the strike price is 45 and then it now drops to 40, but you have to buy back with 45, right? And then plus the premium you earn, maybe the per share you buy is $43 per share, but now it drops to 40. However, since you want to look for a longer terms and you just want to buy the limits there, so you have to really understand that what you do in trading or you are investing or not. What is your plan? So for this cash secure puts, you are aiming to like buy limits. It's like buy limits. You want to wait the stocks to drop down to the price you wanted, and while waiting, you just get extra money to your pockets. And make sure the stocks you do this put option selling is the stocks you willing to own for a long term. And you choose the strike price conservatively based on your risk tolerance. When you sell puts that is too far, the premium will be low. And when it's too near, the premium you get will be higher. It depends on your risk tolerance. And last one, we need to monitor the market and adjust our strategies as needed. And avoid using these strategies when it's in a highly volatile market without sufficient research. Okay, let's go into more details a bit about strategies selling cash secure puts. So let us recap again. So the purpose of selling cash secure puts is to buying a stock at discount or even for free. Why is for free? Because when we keep getting the premium, eventually, maybe for 2 or 3 years, you get 100% of the premium, then you can buy the stocks for free. So it's like the passive income. Maybe if you're aggressive, maybe someone can do 40 to 50% per year with conservatively. So imagine if there is downtrend for a long term, like 2-3 years, and you keep selling the puts, and the price didn't drops below, then maybe you can get a good money in the long run. So the purpose of buying a stock by selling cash secure puts, our purpose is buying a stocks at discount. So as a value investor, here I need to mention that it is for value investor because you want to buy the stocks at limits and you want to hold it for a long time. You have to identify a fundamentally good companies that you want to own for the long term. Examples, 100 shares of Coca-Cola, KO. Then you wanted to buy it at a discount. Let's say it's $46, and now the current price will be 47.15. So while waiting to buy limits at $46 and earn nothing, you just sell the puts at $46 and you can directly earn the premium. Let's say instead of waiting until it drops to $46, you decide to sell KO puts, 46 puts, and collect the premium. Let's say the premium now per share is 0.57, that 100, you get $57 premium as profits, while waiting it drops to $46. So this is the beauty of the selling cash secure puts, right? So if Coca-Cola shares fall below the strike price 46 by expiration date, so what will we do? So if it's fall below the strike price, it means that the put buyers will exercise the rights. The put buyers win this game. I mean, win this contract, because put buyers, they want the price drops, and then they will exercise to sell their stocks at the strike price. So as a put sellers, we are obligated to buy the shares at $46, which is strike price, and for this, and then less the premium I have collected, and then plus the premium I collected is less than $46 actually. So if Coca-Cola shares do not fall below the strike price, let's say it's $46 by expiration date, what it means? It means that the put buyers didn't exercise these options, put options. So we as a put sellers will earn maximum profit, which is our maximum profits will be the premium. All right. So we will keep all the premium as profits. So this is basically the ideas of selling cash secure puts. I hope you all really understand this. If you all don't understand, maybe you all can leave chat in the chat box and let me know, and I will try to answer you all. So don't be shy, because we got plenty of time here, and I hope you all did really learn something from my sharing sessions. All right. So another case study, and I want to buy the 100 shares of AAPL Apples for my portfolios, and the current price is 240. So you all make sure you all just keep when see your examples, maybe you all can try to answers by yourself first. Then you all have the better understanding about these cash secure puts. Then you would like to buy it at a lower price, let's say 225. So here we can decide to sell one contract of apples, let's say 31st March, $225 puts, and this contract has an expiration of 43 days. So what is the total premium we collect? Right. So you just want to make sure, if you want to sell puts, you need to sell puts equals to buy limit. When you want to buy a stock, where is the price you want to place? Then the price you want to place will be the strike price. So here, now the current price is 240, while waiting if we want to buy it at 225. So while waiting it falls to 225, we do a sales, we sell cash secure puts. And what is the total premium we will collect? Once we sell this sell puts, we will immediately get the premium. So we all can go to the maybe desktop or mobile apps of this Usmart. Then we press put, then we search Apple and we choose the option, US options there, tabs. Then we go in put, and we will get the bid price. Look at the way like this here, $225. The bid price is 3.150. So by selling puts, we will get 3.15 times 100, which is $315 premium. So is it worth it? At least it's a few percent in your total portfolio, and this is a good passive income, because once you sell it, you directly get this amount of money, and you can keep on repeat. Let's say in 10 months you sell it and it didn't drop to 225, your total will get 3,150, right? And then if it hits below or equals to 225, you need to spend 225 times 100, which is $22,500 to buy the stocks, because you initially plans to buy the stock at 22,000 at 225, because one contract will be 100 shares, so you need to prepare at least $22,500. All right, this is not that hard for you all to understand. So how do we choose the stocks? Well, we only sell puts on fundamentally strong stocks. Remember that, because we want to sell the stocks and buy it at low, and we want to hold it for a long-term one. And we need to only choose those. Maybe you all can choose this index like Nasdaq, like SPX 500, or Magnificent 7, all these strong fundamental stocks. Try to buy those big cap stocks, and try not to go into the mid cap or penny stocks, because it's unstable. And we want to earn a stable premium, it's better go for these good fundamentally strong stocks. And we should ideally have the cash in our accounts to buy the shares. Because when the put option expired in the money, which is below the strike price, we are assigned the stock. We need to buy the stocks from the put buyers. Always prepare the cash. If not, you will face massive loss. For just now the case, you should have like 100 shares times 225, which is $22,500 cash set aside. All right, this is the idea, and I give several examples, and I hope you all understand on what is cash secure puts. So for entry strategies, first, we need to ensure the stocks is on uptrend. And we sell the put options when the IV is more than 40 to 50. Usually when we do a buy, as a buyer of put options, we want the IV, which is implied volatility, below 40 to 50. So here you all just, this is just a guideline. You choose those IV with 40 to 50, and we sell the put options. Well, and then we hope we sell an out of the money put at our ideal strike price. With the strike price will always be the price you want, the buy limits you want to buy the stocks. And the expirations, they will be, I normally choose 35 to 40 days to expirations, because the longer the expirations, the premium will be higher. If the expiration is very near, the premium will be low. Then you have to keep on repeat. But it really depends. For me, I just want to sell the put like maybe every 1 month plus. All right. So this is just a guideline on my entry strategy. And for exit strategies, so let's say for scenario 1, the stock price is at or above strike price. So what happens when it's at or above strike price? When it's at or above strike price, it means that the put buyers didn't exercise, then we don't have to buy the stocks from the buyers. Then we earn the maximum profits, which is maximum premium. The option expires worthless, and we keep the entire premium as profit. And we consider selling a new put options at a new expiry date and new same strike price, and we keep on collecting the premium. While we waiting the price to fall out, if this month it didn't fall out to our intended strike price, it didn't hit, and we didn't have obligations to buy the stocks from them, then we just keep on get the premium every month until it hit the strike price or below the strike price. So the scenario 2 will be the stock price is below the strike price at expirations, then we will be assigned the stocks. We need to have the obligations to buy the stocks at the strike price. And the 100 shares will be appear in your account, and the cost of the shares will be deducted from the account. Means you hit your buy limits. You hit the strike price and you hit the buy limit while you're getting the premium while waiting. It falls down and you'll get it at a discounted price. So once you own the stocks, you can consider selling the covered cost. These strategies we call build strategies. When you sell puts, then you sell covered cost. So for those who don't know what is sell covered cost, maybe you all can look back to my sharing session last week. And I think here we don't have much time. Maybe I think next few sharing sessions I will combine and talk about these strategies again. How do we sell? Because sell put is buy limits and sell covered calls is TP, take profits. The idea is buy the stock from people and sell the stocks from the buyers. It is the same. So this is how we benefit it while we waiting for our TP. For selling covered costs, while waiting for our TPs, we get to earn extra money. So it's also a win-win situation. So for summary, the advantage of buy stocks for selling cash secure puts will be buy stocks at discount or even for free. And we get paid while waiting for our ideal price to reach. Then we keep on collecting the premium as profit as long as the price remains above our strike price. And for the risk, the same risk as the buying the stock outright. Is the same. Like you buy the shares, it drops, you lose the money, and it goes up, you earn the money. But the advantage here will be you get extra money while waiting it to drop. So I think today my sharing sessions is not that much, and I hope you all understand what is selling cash secure puts, and I hope you all understand this and can benefit in your long-term trading, long-term investment in futures. Because sometimes while you're waiting, the stock drops to the price you waited for, it can be few months or maybe years, right? Then while waiting for it, you will get extra money while waiting the markets hit your strike price, which is your buy limit. So remember, this is a very conservative and very safe and win-win situations in strategies. And Warren Buffett like it the most. He is very good at this, and he always do sell puts while waiting the stocks price comes down. This is, and remember, Warren Buffett is also the best option traders I think in current world. The most successful option traders. Warren Buffett is a part of long-term investing. Warren Buffett also is a good option traders. So this is what I share today. And any questions, maybe you all can leave it in the chat box, and I will try to answer you all. Maybe another basics questions, or you all want to know what stocks can monitor. Any questions? No questions? Okay, no questions. Then here is my Usmart apps referral code. So you all can consider to add me to use my code. The left side one is Usmart Hong Kong apps, and the middle one will be the Usmart Singapore apps, and the right side will be the WeCom. WeCom is one of the WeChat apps. You all can consider to add me if you want to reach me. And any questions, you all maybe can PM me and let me know what can I share in the next few sessions, and what you all wanted to know, and I will think about, I will see about the response and do a preparation about it. All right. So this is the Telegram group, but I think inside there it is not so active yet, and I hope maybe if got enough people join, then we can talk more about trading. I think a part of option trading, I also talk about grid trading, which is automated trading, and I also talk about trading psychology. I also share about how to become a profitable trader inside, and I also talk about how to do long-term investing, all this. So if you're interested, you all can reach me out or maybe join the groups, and maybe we can become friends and do a chit chat. And hopefully in futures, you all can get a better knowledge, get a good knowledge, uh, and have a good journey in this trading world. All right. So for today, I think that's it. So that's it. And thanks for joining. And I hope to see you all soon in the groups, or maybe you all can reach out me. I hope you all learn something. Right. Peace. Hope you all may the market with you all, and all the best. Have a nice day, everyone. So before I end this, the risk disclosure and disclaimer. Have a nice day. Oh, sorry. I just saw the question and answers. I just saw the question and answers. And for cash secure puts, can we put the cash in our account nearer to the option expiry date? No, it's advised that you put your cash. It's advised that you put the cash. Sorry. For cash secure puts, can we put the cash in our account nearer to the option expiry date? No, it's advised that you put the cash beforehand, before you open. It needs you to put the enough cash. If not, you cannot open the 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 markets. I mean, it doesn't mean that you cannot, but you need to bear the risk because the markets can be very volatile, right? Get out, get down. So it's advised that you better prepare enough cash. All right. L Chan. Sorry, I just know that there's few people ask me questions, and the put buyer must own the shares before he has the right to sell to put seller. No, the put buyers, they don't have to. Yes, the put buyers don't have to own the shares. For cash secure puts, can we put the cash in our account nearer to option expiry date? So L Chan, I hope I answer your questions. You better prepare enough cash, because when it goes wrong in sell puts, you can get a margin call or lose a lot of money. All right. Okay. Then I will end my sharing sessions today and have a nice day. Hey, wait, what is the benefit of, oh, sorry. What is the benefit for a put buyer? So for a put buyer, you earn by the price drops. You earn when the market price drops. You can look back to my put buyers trading introductions in the last few weeks sharing sessions. For the past, can look back to my past sharing sessions. All right, I think no more questions. And I hope you all have a good day. And thanks for joining me. See you all next week. The buyer is speculating that the stock price will decline if the stock price drops.